Kris, good to have you here again. Thank you so much for being here. From growth to value, potential multi-baggers goes by a bunch of different titles and things that you're offering to the community. I really appreciate you being here. You just recently wrote a Seeking Alpha article on Upstart. This is a stock that
Correct.
you hold?
Yes, it is. It is. It is. So first and for all, thank you for having me, Tanner. I'm really happy to have a talk with you again. I really
Yeah.
enjoyed it the last time, so I'm looking forward to this one.
Yeah, and this is a stock that's very interesting. Whether good or bad, high risk company. From what your article actually said, it's down 92% from their highs.
Yep.
But that being said, who knows if it's a recovery play? And we're going to talk about it. So,
Well,
what do
and,
you
and what
think?
and before we start, maybe already, one of the crazy things is, if you look back on, the bubble that we have had,
Yeah,
many of the companies were extremely expensive. I mean, like, 60 times sales or so. Upstart has never been, in that category. Um, so, up to a certain point, the valuation even looked very attractive, even at, 200 or $250. It still looked attractive on a forward basis, but that's the problem. That forward basis didn't become reality.
yeah, yeah. But let's sort of break this down. So, first off, I'm new to Upstart. You've been a shareholder for how long now?
Somewhere 2021, I think.
Yeah,
Yeah, but I'm not sure. I should check that
but
if
you've
you
been
want to know.
following management for quite some time, and a relatively new management team, correct?
Not really. I mean, relatively new in that sense that the company has not been a public stock for that long.
Right.
It IPO'd in December 2020, and that's basically I followed it since then. But they already started the company in 2012, and so the management, so the three founders. Well, let's focus on that. You have Anna Councilman as well. She also comes from Google, together with Dave Gerard, who was actually quite important at Google. He was the one who founded and grew Google Apps, which is now called Workspace. So
Okay.
he brought it from scratch to more than a billion, and then he wanted to start his own company, and he wanted to focus on the problem of credit, especially for to make it fair. And then he met Paul Gu, who's actually a WizKid genius.
Yeah.
And yeah, so but
He's the whole
they
brain behind the algorithms, correct?
Yes, he is, and he is a genius. It's easy to say that from thousands of people, but he was a Peter Thiel fellow. So if you don't know that, 20 people are chosen, uh, young people under 20, I think, something. Just they get money, and they can start a business. And
Mm,
Paul Gu was one of the people that Peter Thiel chose there. So I mean, that means something, right?
right.
Well, that actually means a lot, because it's also called the Genius Grant. So it says something.
Makes sense. Makes
Yeah,
sense, right?
yeah,
Um, so just uh, from a very beginner level, Upstart is a platform that tries to price loans better than FICO scores, originate them for bank and credit partners, and sell them and take a small fee for pricing the risk for that loan, and
yeah.
hopefully better than maybe how the banks would have done it themselves.
Yes, and the numbers show that their claims are true.
I'll go ahead and share my screen while you're talking.
Yeah, I mean, maybe you can share that graph. Yes, this one. So 53 fewer defaults at the same approval rate and 173% more approvals at the same default rate. So that's huge. That's not a marginal gain, right?
Yeah. Yeah.
That's a huge difference for banks and credit unions who can use this to even and that's to even so they do much better than FICO. There's no doubt
Mhm.
about it, because there's also there's also
Where is it?
yeah, there it is. If you could zoom in a little bit, there you can see the difference. So for example, let's take a FICO score of 700 or above. Then Upstart has several categories, and you see A plus, for example, that's just 1% default, versus, and totally on the right you can see that the average of 4.2% for FICO. Now,
Right.
if you look at Upstart's E minus category, there's a default rate of 12.2%. So while FICO will say, "Oh, this is just 4.2% on average," this category, Upstart can give much more granular details to their customers, to their banks and the credit unions they work with. So this is very valuable information, of course.
Right. So just the way I'm reading this chart. So if FICO was only looking at it through that system, 700 plus would average 4.2%, whereas a in the same category for Upstart, which would be an A plus lender who necessarily doesn't need 750 plus FICOs, would actually average around 1.3%
Exactly,
default rate,
exactly.
more than
Even
12 times.
Yes, and even a FICO score of 639 or below, A plus only has 4.7% versus 4.2% for FICO. So even if Upstart says, if FICO said this is an awful lender, and Upstart says, oh, but it's an A plus, then even then, at that, because of course banks will use both. Um, you can and banks and credit unions can play with the two, so they can say, oh, okay, we want as little defaults as possible. Okay, then you go for the 1%
Yeah.
default, or they say, we want more loans, so we can have a bit higher defaults, because the APRs, the annual percentage rate, is higher as well. So we still make quite a bit of money of that, and so they can really play between the two poles of what they offer.
So I think what was really exciting whenever I was first reading the article and learning about Upstart was that, like you just said, there's this massive total addressable market that maybe can be uncovered of not so risky borrowers that don't fit under the traditional FICO score niche.
Mhm, mhm.
And if total
Well,
or and if Upstart can find that, then there's a lot of money to be made.
well, I will give an example from real life, because I think that if you see the numbers, it says a lot, but a real life example will make it clearer as well. I think I have a subscriber who works for an investment bank in New York, but because he's Spanish and he has no credit score in the U.S., he's I don't know. He has no FICO score. So he could not take a loan at all.
Right.
So if eventually, because he's a subscriber of potential multi-barriers, he saw Upstart, he applied, and he immediately was approved, and he was very, very happy that he could take a loan, because otherwise he couldn't. And I mean, this is an investment banker, right? I mean, this is somebody working in the business of investment bank. Not He's not an investment banker in that sense, that he's not the
Sure.
boss there, but he makes more than enough money to pay back a loan, but he was not approved by no one wanted him. So and that's the people that Upstart wants to go after. So the not only those prime people who fall out of the boat, but everyone that has an unfair FICO score. So
Right.
even, for example, if you haven't taken out credit before, um, so that's bad for your FICO score. So
Mhm.
while Upstart can help you there.
So that brings me to another point of that it's not just a better risk model, it's also the speed. It's the full automation of and this quarter is breaking new records. 84% of loans were automatically approved.
Yes, and Dave Jarrett, the CEO, also shared it on the conference call that people who applying for a loan are often shocked that what is this? It's just 5 minutes and I have my loan or what?
And
So
then that leads to what whenever it comes to their NPS scores,
yeah,
83 or something that you said.
that's
um
amazingly high. I mean, last time, and that was already months ago, but last time I checked, Apple's was 61, for example. For people who don't know, NPS goes from minus 100 to plus 100, and everything above 50 is seen as outstanding. So if you know that Apple has 61 or so, what last time I saw it, a few months ago, um, and you know that the Upstart has 83% and more than 40,000 ratings of excellence in Trustpilot, which also says something, right? Because Trustpilot is often a place where you go to complain about things.
Yeah, well, I mean, that's the thing too, right? Even comparing against Apple is a strong competitor. If you base it against some of the larger banks, I was looking like the large banks are lucky to get above a 30 rating
Mhm.
on an NPS score.
Yeah, I've
So
looked at the banks as well, and generally they are, between 25 and 38. I thought the highest was. I'm not sure, but
yeah, I'd love to
that's
know
that's
that
the
news.
range. That's the range of banks.
Right. Yeah. So, um, but so I on a first look at this company, which I'll even pull up my screen again. Um, Things don't look great whenever we start looking at the numbers immediately, right? Revenues
Well,
down 30% quarter over quarter, but down 67% year over year. And this trend can kind of be seen across all of their profits and their net incomes and everything. Nothing is really looking great whenever it comes to the immediate financials.
I think not great is a euphemism for awful.
Yeah.
uh, so yeah, the numbers are really awful, and I think that that's one of the reasons why the stock is up so much right now. Not because they're awful, but because the company has guided for 35% revenue growth quarter over quarter now,
Yeah.
and that's still down in Q2. Then still that would, if they meet their guidance, that would still be down like 45% year over year.
Yeah.
So still not wow happy party, but it's much better, and I think that you have to know why the revenue was down so much. I think that's important. I don't think that the company made big mistakes here.
Hmm.
uh, it, it- this is a consequence of what we have seen, with the high interest rate hikes, um, the fastest in 40 plus years. um, and of course, um, in my article I explained it like this, and I will do that again here. If you are an investment banker, and let's say we go back a few months or a year or so, and the interest rates are at 2%, and you can, Upstart has a loan for you, you can buy it, and you get 7% um, interest rates. So that sounds quite good, right? But the Fed chairman has said, maybe not yet at that moment, but you see that interest rates are still being hiked very fast, and eventually Jay Powell says that the Fed targets 5%, 5.5%. You know, if you have 5%, you know that you can have a yield of 12%. So what would you do? Would you buy immediately at 7%, or would you wait a few months to buy it at 12%? Well, I think many banks took the reasonable choice there to wait. And that's still what you see playing out right now. And now that interest rates are um, are not going up so much, or not expected to go up so much anymore. I think we are probably at peak or near peak. Um, you know, could still be added, quarter of a point, or percent, or
Right,
maybe
right.
half a percent. Who knows? But
We're
I don't
close.
think I don't think anybody thinks interest rates will double again. Um, so you, you, that more stable environment will already help Upstart, and of course on the other side of the equation you have the consumer, and for regulated banks there is an upper limit of 36% APR,
Yeah,
so they cannot not ask more, and because of the bad scores of several of the consumers that Upstart um, safely gets into the system normally, those people are pushed above that 36% level, so they cannot even give the loans even if
yeah,
they wanted. So and also, even if they are lower, I mean, if I have to take a loan and I see that I have to pay 25% APR, I would wait, or I maybe would forget all about it to start with. I mean, um, and that's the reaction many people have as well, because of the much higher APRs, and that they are used to much lower. Nobody um, who's younger than 60 years has seen this in their adult life.
right.
Um, so they no, I'm wrong. In the 80s, well, that maybe a bit younger than 60, but you know what I mean. Young people have not experienced this before, and predominantly younger people take loans, of course. So yeah, this was a perfect double storm for Upstart, and the whole credit industry, because it's not just Upstart who sees volumes
So
drying up.
so let me make sure I have that right. Um, as these the cost of the loans are going up, the APRs are going up for the consumers. Either they're less affordable for them, or they're passing the threshold, and so they literally can't give them out. Or on the other side, institutions are just not simply wanting to buy them because they might be more attractive at the higher end of the APRs, and so they have the flexibility of just waiting,
Yeah,
right?
that's
So
that's the double, the double attack that Upstart and its peers have experienced, in the last year and a half already.
right, right. And I also read something along the lines of every 1% of APR that um, Upstart has to offer, they lowered their conversion rate by like 15% or something like this.
Hmm.
So this is one of the reasons also for one of the numbers that I wanted to cover as well is their conversions. I guess this sort of scared people. There's so many cool things about this company lately that I wanted to cover. I mean, the contribution margin is so incredible that we need to talk about their conversions, all these things. I don't even know where to start. So,
Let's start with
um,
conversion, because that's another very important number, and conversion shows what I've just said. So if you look at Q1 2022, conversion was 21%, and this quarter it was 8%.
oh, wait, let me see
So
if I can get down to
yeah,
the bottom line here.
yep. So you
Go
can
ahead.
see that there, 8%, and it comes from 21% in Q1 2022, and even 11% in Q4 2022. So and if you would go back further, I can remember even higher numbers. I think 24% even. Um, I'm not sure. This is just from the top of my head, but it was something like that. It has been higher even in previous quarters.
Let me
So
see if I can bring some numbers up. That way we have a better.
mhm.
Um,
I'm not sure which quarter that was, but there were even higher numbers. So I mean, this shows in numbers what I have just said. Um, is conversion rate there?
Where are we? Conversion rate. Yeah, as high as 24.4% in
Yep.
Q2 of 2021.
Yep. That's the one I was talking about,
23,
24.
24.
Yeah. You see, and now 8%. Even if you look at Q1 2020, and then it's 40%. And then
Yeah,
Q2 2020,
still
5.7.
lower.
Yeah.
That's 8.7.
Oh, 8.7. Yeah.
Yeah,
So I mean that was the pandemic quarter, um,
try to.
which saw credit applications drop from a cliff as well. And you see
Right.
that it's even lower right now. And the reason is and there's always some sort of lag between interest rates and credit. Um, yeah, you can perfectly follow that in the numbers.
Yeah. So, I guess some of the great parts about Upstart is that, um, unlike a SoFi or any of these other lending companies that I follow on the channel more often, is that Upstart, for the most part, and we're going to have a correction here, but they don't actually take the loans on themselves, so they can grow as fast as possible. As long as they have an audience, right? They can service those loans, or that institutions, correct me if I'm wrong, they can use Upstart's platform to assess the risks of the loans, but they're actually bringing in the lead themselves.
Yeah, both are possible. Well, so they can integrate Upstart's software through an API,
Hmm.
and then they can integrate it on their own site, and you don't even see that it's Upstart's. Um, or Upstart originates loans themselves as well on their own platform. So you have both systems. Um, the white label uh, solution is a bit lower um, margin, but not that much. Yeah, they have both, so they can really scale it, and they worked with just 10 banks and credit unions when they came public in December 2020, and they already work with 100 now. So that 10x in just 2.5
Yeah.
years.
So for the longest time, they were just selling these loans. They took an opportunity where they agreed with the market and how well risked these loans were. And I think they picked up some of their loans for themselves, held them on the books. You probably know the numbers better than I do, but um, this kind of changed the way people look at the company now a little bit because they're now holding risk.
Well, there are two parts to that story. One part is they have always done that, and the reason is R&D. So
Yes. Yeah.
before they start a new line or a new product, they take the loans on their own balance sheet to test it out, as it were. So they take, for example, right now that's in car loans, or
Hmm.
has been in car loans for quite a while, and they take car loans on their, yeah, you can see the numbers there. um, so that's about half of the total credit they have on their own, or the total loans that they have on their balance sheet. So that's just for trying out, and they have sold the first one right now because they think that the product is ready for launch.
Right.
So what you saw before the IPO, they had exactly the same thing with personal loans, and they sold off everything um, from their balance sheet. So at the time of the IPO, they had no loans, or less than 2% of the total balance was in loans. So basically,
But
almost nothing. So that's one part. The other part is to fill the gap. So what I mean there is they saw that there were loans um, that were not bought. So they had, they originated more than enough loans. So the what I was talking about previously, banks have said, "Oh, we're going to wait," or credit unions say, "We're going to wait. We're not going to buy right now." Upstart took what it thought were the most attractive loans on its balance sheet as well there. So to fill up, you know, the gap as it were a little bit,
Get a
that
little
short
interest
that
income, eh?
and indeed get that interest income. So,
Yeah.
but indeed, the market didn't like that move because they said, "Oh, now they have credit risk." So,
Yeah. Yeah. Well, yeah, it is one thing like if they are that platform, it's how do you want to risk it? Like does Airbnb start to get into housing or or one of these types of things, right? So but
well, and
management
I think it's important because I have seen, since I followed Upstart for so long, I maybe have seen it as well because up to recently you could read on Twitter or anywhere you heard things like, "Oh, this company is going this is going to zero." Well, just like take a look at the balance sheet for just 1 minute, and you would see that there has never been a moment in which the company has been in danger of going bankrupt or so. I think that's very important to know as well. So if you and I even heard that from people that I thought were more
well
intelligent than I estimate. Insiders from and insiders. I mean, people who have been in investing for 30 years or so. Now I thought I might just look at the balance sheet. There's no way.
but that's a
Even
function of two
even
things, right?
yeah. Go ahead.
Well,
I
I was just
just
going to
want to
say
say
that
something.
one, that they also said they're not going to go over $1 billion on their
Hmm.
balance sheet, so
Yep.
they're not looking to grow this on their sheet. And two, also they are a better loan. If you're trying to compare them apples to apples with a bank, they're 173% or whatever likely to not default at the same rate or
Yep.
whatever. I'm getting my numbers mixed up, but
Yeah, no, you're right. You're right. You're right. And that
so
was my point as well. But on top of that, I took a worst case scenario. Suppose that their loans would perform as if there would be the great financial crisis. So I took the loss rate of loans of the great financial crisis, and I mean bank mortgages.
yeah.
So that was, that was a bloodbath, right?
Mhm.
So even if you applied those numbers to all the loans that Upstart had on its balance sheet, no way they would lose. I mean, they could lose a bit, but no way they would go bankrupt. Impossible,
Right.
impossible. So that's what you should do. If you say something like that, you should have the facts behind it. So to support it.
So I think we looked at a lot of the cases of this is maybe why Upstart is not as scary as some people would think, although it is down 92%.
Mhm.
Um, the reason how it got to such an elevated price in the first place a couple of years ago is because when they do flip the switch and there are buyers of these loans, they can ramp up their revenue 50% quarter over quarter for multiple quarters in a row. What's to say
Well,
that won't happen now?
we
Let's
saw
let
we
let's
saw
flip.
the we saw sorry that I interrupt you, but
No, go
we
ahead.
saw that we saw the pandemic quarter there with a conversion rate with 8.7%. The year after that one, they ramped up revenue by 1,200% something. So
Maybe I can bring the numbers back if you'd
I
like.
think so. I think so. It was something
Um,
like that. And again,
here.
this is from the top of mind, so from an older article, but it's something like that. 2021 that
Yeah, so
must
if we're
have
just
been, but
looking at revenue from Q2, what is this in millions? 17 million to 65 million in a quarter to 86 million to
that
121 million to 193 million. Like,
yeah, and then goes up to 310.
yeah,
So
to
but
310.
so if you compare, I think there was one quarter of like 1,000% or more.
And
um
who knew? We're just looking at revenue too. So, um, there's also statistics here going from Q1 of
Yeah,
2021
yeah.
to Q2 of 2021, just in adjusted EBITDA, tripling
Mm-hmm. Mm-hmm.
quarter over quarter. I
Yeah,
think that's the
quarter over
same thing
quarter.
roughly, or even more, almost four times in earnings per share.
Ah, yeah, it must have been earnings per share. Probably must have been. Yeah, yeah, sure. Of course not revenue. Must have been earnings. Sure.
Yeah, but
That would.
still,
Yeah,
like,
oh, yeah. Q4 2020 and Q4 2021. Yep, that must be it.
right, right.
That must be it. Or even Q1 2021, Q1 2022, and of course revenue not.
Yeah, but like
Well,
this
it was
is
up a lot as well, as you could see. And indeed, if you look at Q1 2020, which was not their strongest quarter either, 64 million. Q2, 17.4 million. So that was the pandemic quarter, 17. And then Q3, 65. So they're already back in one quarter. Now, that won't happen now because the we have more fundamental things going on, but they can return very fast, and I think that is underestimated, and maybe not by the market because the market has pushed it up like 120% of the last month or so.
right,
um, but
right.
I think many people still underestimate that um, things can change fast in both ways, so up or down.
And so, but this is also one of the things that you covered. I had no idea about for Upstart. For the most part, there are, or maybe for all of it, there are personal loan. All their algorithms are designed for personal loans, um, to get better risk for all those loans.
Mhm.
Now they're about to launch auto loans, which is a much larger total addressable market. They're getting into small term or short term loans, which is to sort of go after the payday lender style of companies that are ripping people's eyes out at above 36%
Mhm.
APRs. And then lastly is HELOCs, home equity lines of credit. They're also looking to completely change that industry, all
Yep,
with similar algorithms.
and of course, if you look at cars and home equity lines of credit, um, both are much better actually than personal loans. Why? Simply because there is collateral.
Sure.
So usually you see that the defaults are much lower there, even lower. And I think and those are huge markets as well. And indeed they have the target to eradicate what was it again, something like 70% of payday loans in 5 years or so. I mean, that's great for society as well, not just for Upstart and for the banks, because regulators push banks to do away with overdraft fees, which are
Right.
usually very high as well, as we all know. And short-term loans should be an alternative, but banks are not able to offer them profitably. And Upstart sees great results in their testing, and they can even automate it much more there at 90%. And they say that the results are really starting to trend in the right direction. So yeah, I think probably next year or so they will launch this. Maybe even I don't think so. I think they will do it slowly, as they usually do, to know for sure that the AI is perfectly programmed to to catch all the risks.
Yeah, like so many things I got excited about from your article. Like one of the ideas, and you tell me if I'm wrong, but like the conversion rates and these sorts of things that are failing on Upstart side is a little bit like contributed to a macro side, and probably majority contributed to a macro side, just because their users are being priced out of the market from things that Upstart can't control.
Hmm.
The things that they
Hmm.
can control, like their percent of automated loans, is continuing to improve. I think you said even this quarter there was 26 new upgrades to the algorithm. Probably on their
23, I think, but yeah, something like that.
but they're continuously learning, and that's going to continue to grow. Versus this FICO score that was designed what 60 years ago. I don't remember when you said, but
Hmm. Yeah, it must be
um,
something like that. I don't know exactly, but it's a long time ago.
yeah, or
when
probably longer than that.
when the animals could still talk.
um, but so yeah, I mean, tell me about this as well, because one of the exciting things that Upstart also did was their contribution margin. It's getting a
Yeah,
lot better, and they've been cutting costs as well. Can you tell me a little
yeah.
bit about that?
Yeah, sure. I mean, they have, they had to let go a third of their employees, which management called really gut wrenching. And yeah, they can now be profitable at a much lower number of loans and lower conversion rates. So yeah, they have looked at profitability, all over the place. So also, for example, their tech stack, they can save $10 million a year on that, et cetera, et cetera. So yeah, they have cut costs. I found it remarkable that unlike many other companies, which I mean, if you look at the companies that have cut their employees by a third, you see that their Glassdoor ratings have plummeted. Just look at Glassdoor rating of, for example, Mark Zuckerberg. It's in the 50s
Sure.
now. It's in the 50s, and he was when Glassdoor started, he was number one
Yeah.
overall. So that was 10 years ago. Okay, it had already trended down a little bit, but it was only when Facebook fired people that his overall rating really plummeted. For Dave Gerard, he still has 69% ratings, which is not great, but not bad either. Especially if you know that so many people had to go.
It's one of the functions of building an AI based company is a lot of these people are coding themselves out of a job in a way. If you make the algorithm too good and the automation goes up, what are you there for?
Well, I think many people will have been in the sales and marketing department, because
Very
sales and
true.
marketing was down. Spending was down 52.5%, um, year over year, and the reason is, it's quite simple actually. If you just think level headed here, if you cannot sell the loans you originate,
No point in fighting
to
it.
no point in originating them, or spending. So and that's also why the contribution margins, so contribution margins are more or less gross margins, have gone up so much. They're guiding for 60% in the next quarter. And Dave Gerard talked about this on the call, that um, they can actually play with the contribution margin. So there is pricing power now for Upstart, which means that many people cannot get a loan anywhere. So Upstart has some pricing power to give loans and to have a bit more margin there. And then both for themselves and for their partners, of course,
Right.
because that makes it more attractive for banks and credit unions as well to buy those loans. And once the market turns, once there's more supply of credit again, then Upstart will start spending money on sales and marketing again, and let the contribution margin drop a little bit. So there's the communicating vessels, as it were, between the margin and the macro context, actually, as it were. So the higher Sorry, the higher interest rates, yes, and the tougher the environment, the higher the contribution margins, and vice versa.
Yeah, yeah, which I found was really interesting. I thought now is not the time you want to get an Upstart loan because it's when they're taking the highest take rate.
Yep, yep, and they're still lower than the others.
Sure enough. Well,
Mhm.
um,
And of course, I sometimes hear that as well. Oh, it's a predatory lender. I mean, that's a mistake. I mean, if of course, if you
it's
have
designed
a
not to be.
very if you have a very high FICO score and you go to your bank, you will probably be able to get a better rate. But that's not a typical public for Upstart. If you look at the rates, the APRs that uh, Upstart's customers usually have, Upstart is a great improvement for them. And you will see the same thing with the alternative, the short term loans, compared to the payday loans that will be cut in half or so, or even
Well,
more.
yeah, that wasn't even the impression I got at all. I mean, from what I could see, Upstart could have a great impression on even the most affluent uh, people as well, because whenever introducing both Upstart's algorithm and FICO scores, there's still an improvement.
Yes, but right now, one of the problems is that the you know uh, a lot of banks still don't use FICO, so they will look at you as a customer and see your history and combine that with FICO, and then you can still get lower loans if you're a prime customer. So if you're affluent, you will think that there will be higher APRs usually, but from the moment that you're not in that top class, you see your APRs going down.
Yeah. Okay. Okay.
So it's simple. It's not Upstart's target market
Yeah.
to
Yeah.
have those really prime loans.
So essentially, Upstart's entire how fast they're going to grow is dependent on how many banks and partners are looking for loans. Right? They can grow at essentially the speed at which the banks are actually willing to acquire them.
Yeah,
Um, and so this is what's really exciting is that if we do get to the top of this potential interest rate hike, that is when, as long as defaults stay in under control, that's when there's the most juice in these loans. That's when the net interest income will be at its highest. And I
yeah,
think
sure.
maybe why the stock went up 130% is because things can turn around very quickly for Upstart. Um, like what do you think about whenever I think I read in your article you were talking about how a lot of the partners that are coming back, there was a $2 billion deal that was signed. I think you said there was another $4 billion, but we didn't know if this was new or old, or tell me if I'm mistaken.
Well,
But
it's new, but it's not sure if there was not already a part in that 2 million, 2 billion. Sorry,
mm,
the 2 billion was from several partners, and the 4 billion was from one partner, and we're not sure if a part of that 4 billion could be included in the 2 billion. So that's unclear. But from what I read between the lines, it's probably 6 billion additionally.
sure. And this is from existing partners that stopped using Upstart. They don't have a problem with using Upstart. It's more of a macro environment of just we can wait. So it's the same
And
customers
new
that are coming
partners as
back.
well. Yeah,
Sorry.
same partners and new partners. Yeah, it's not that they have bad experiences or so. It's just as you say,
Right.
it's a macro environment and context, and what happened to SVB had a great impact on how banks you know behaved. Banks are usually very conservative, but they you know now they even looked twice or 10 times maybe at the same thing that they would have only looked at once in the past. So to be even more conservative, because they you know they saw what happened at SVB and a few others, and they wouldn't want to be in those shoes. So they were extra conservative. So that also played a role.
Right, right. So, I mean, it is looking quite interesting, Upstart, knowing that um, if the numbers hold true that we said at the beginning, that this is a better loan for banks at the start, and it's so much better of a loan that they're willing to even take, a cut. I think it can get up to what 6 point something percent that Upstart will take on originating these loans for banks. Um, that
Yeah, I think that's the upper limit. I think usually it's a bit less, 3 to 4%. So
Yeah, I saw different platforms like certain things they take a 2% fee, they take a trailing fee for servicing the loans fully. Um, but
yeah,
that's the
I
thing.
think the average is about 3 to 4%.
This is a technology company. This is not a bank, and I think a lot of people look at them like a lender, but
Yep,
they're not
yep,
a lender. This is a lending platform,
it is. It is,
and it's
and that's why people who say that this is a predatory lender, they have two big mistakes in one very short sentence. It's not predatory. It's not a lender.
yeah, yeah. They're going after one of the largest total addressable markets that there um, is the lending market, and from the sounds of it, they can go after everything. And this even brings me back to like, are they able to go after pricing in student loans? Because I know I'm a big fan of SoFi. Student loans are coming back. Is this an industry that they would be interested in getting into? And
I have never heard that, but it's one of the things that I thought as well. So it looks like there's a lot of fat there as well, and yeah, I think many people would be helped with Upstart there. I'm not sure. I
yeah,
don't know what they have on their timeline. First, they are going to focus on the three new products and of course the personal loans. Now, one of the things that I want to add is the 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 most convincing bear case that I heard for Upstart from the start was they have not lived through a credit cycle. They are living through a credit cycle right
right,
now, so they are getting enormous uh, you know new input for the data for the AI. They have developed the UMI, so the Upstart macro index, and they can really now use that to price their loans better. So they can also predict where the UMI goes. The best, they have several data points, but the best, yeah, that's the one. Yes, that's the UMI, and you can see that. So the higher, the more defaults, the more loans default,
right,
and you see that we have gone up from March 2021 at a bottom to and the top was in October 2022, which I found interesting. I asked the question, it can be, simply correlation, but that was also the market bottom. Does it have anything to do with each other? I don't know. I have no idea. And you see that it has gone down, it's gone up a little bit and then gone down again. Um, and right now, as you can see there, the personal savings rate is 5.1%. That was 2.1% just, I don't remember exactly when it was, but a while ago. And that's the best predictor of where defaults go, or in other words, where this Upstart macro index will go. So they can now use those data points as well to price their loans better.
right.
So and this is a down cycle. So yeah, that's probably one of the reasons they have updated 23 times, because they get in so much new data that they had data from starting in 2012, and yeah, I mean the situation completely changed, of course, and
Right.
there were no data from, let's say, the 80s or so. So this is totally new, and they see that their algorithm um, learns so much that they have the algorithm uses 1 billion cells to
Yeah.
learn from, and every day 90,000 um, data are added, and the data are repayments from loans. So it's
Yeah.
as simple as that. So that's that. Knowing the power of AI, knowing the genius Paul Gu is, that this is going to help them even get better.
Could you there was a chart on here during their call, and I just actually wanted a little bit better explanation on what we're seeing on their loan performance right here.
Yeah. So the let's start with the thick green line,
Okay.
or a thick, well, the green line, and that's their expected cash flow. So that's the loans that so the cash flow that they expect from their loans. As you see, that has gone up quite a bit. Why? Because of higher interest rates, of course.
Mhm.
Now you can see
Right,
that
starting right
the
around Q1 of 2022. It's
yep.
exactly where interest rates started going up.
Yep, indeed, indeed. And what you see is that Upstart's loans outperformed those targets actually quite a bit, you know, until Q1 2021. Well, that was still above the line, but then it's Q2, it started to go under that line. And right now, you see, but there's still a range there, because the loans still have to be paid back for a part. Um, but you see that they expect to go back to expected cash flow, with the Q4 2022 cohort. So that's actually what this means. So the loans underperformed expected cash flows for a whole while, but they think they are more or less back at the expected
So
cash
is the
flow.
expected cash flow like is that based off other lenders that are using FICOs or
No, no, no. The expected cash flow is their internal expected cash flow. So
oh, okay.
they say, this cohort will probably yield, let's say 7% right now.
Right, so this
Um,
could still be way above traditional lenders. It's just
yeah, it
versus their
is.
own expectations.
Yeah, indeed.
Okay.
Indeed, indeed, indeed.
Okay.
Yeah, because versus FICO, you have seen the numbers that those held up. Um,
Yeah. Yeah. No, I mean, it's I don't know. It's very exciting. I just started looking into this company and you can take a first glance at a company and say it's down 90% bad company, you know?
mhm.
But are you really looking at all the details because a lot of what happened is just completely what happened in the lending market and they're very very susceptible and full risk on the table of they're not even holding these loans for the most part so they don't even get the boost in net interest income whenever the loans actually go up. I mean they did take a little bit and that was a potential good move considering they're not defaulting at the high at high rates but whenever the market is good in a bull market in a lowering rate environment these guys could be smashing it out of the park the same way that they were before in 2020.
Yep, I think so too. And I'm not even sure if they really need a very low rate environment. I think a stable rate environment is very important there. And the low
Sure.
rate, yeah, it often helps, of course. It always helps, of course, but um, I think they could do great with a stable rate as well.
Yeah, because you're the banks are locking in their rates. So
Yeah.
do you want 1% this month or do you want 3% in 3 months?
Yep.
So they go, okay, well, I don't want to lock in now. If we're
And
going to
of
put $2
course,
billion on the table, let's wait.
if you have the reverse, if banks start to think that interest is going down,
Yeah.
that the Fed will cut, then you will see a reverse movement that they want every loan they can buy right now.
Yeah.
So
Ex-
that's what I mean, that it can change very fast and people underestimate that, I think.
no, exactly. I think because then, you want the locked in high rate 100%. Because it even goes for whenever they want to sell the loans on secondary markets. If you're holding on to all these low interest rates, people don't even want to touch those low interest rates because it's opportunity cost. They could go to the markets today where people are getting 5-6%. So they don't even want to touch the old ones unless you give them a steep discount. That's
Yep,
essentially the reason why SVB even collapsed in the first place. Um,
correct.
well, mixed with a bunch of leaving deposits, but
Yeah, and of course, their overall handling of their business.
sure enough. But so I got a question for you, and then your buy sell scale, and then we'll leave it there. One, is this uh, is this company in a potential for bankruptcy right now? Um, can they even live for the next 6 months to see maybe interest rates stay flat?
they can they can live for much longer than 6 months. There has been no moment in which the numbers showed any reason to think that Upstart would go belly up.
Right, right. Do you mind if I share your article really, not the whole thing, I'm just the buy sell
Sure,
scale.
sure. Go ahead.
I
So
just
if
wanted to
people, if
show.
just if people want to read it, it's a public article on Seeking Alpha. So
Yep.
if you're a subscriber to Seeking Alpha, you can read it for free, or well, for free. Yeah, it's if you subscribe to Seeking Alpha. If you are not a subscriber, there are like 5 free articles a month or so you can read on Seeking Alpha. So if you have not reached that limit, you can read it as well.
I'm actually sponsored by Seeking Alpha, so there's a lot of people in the chat who are also Seeking Alpha readers. So um,
They can all read it.
you placed a point in this company. It's buy, sell, or hold, as a slight buy, maybe a hold on this company.
Yeah.
What do you think?
I call it a very light buy. And what I mean is, I have added to my position, but I don't think that this should be a top position. This should be held quite small because there is substantial risk, and the risks are not as much that the company will go bankrupt. The risk is, for example, that the market will continue to see this as a lender, and then will give it a much lower multiple. Uh, right now, I think the multiple is still it's still higher than lenders. So yeah, but if the market can starts to really see this as a lender, it will be wrong. But the market can't be wrong for a very long term, for a very long time. Um, um, so yeah, that is a risk. Um, you know, there's another risk that they have the 6 billion in funding right now. Will that be sustainable for the long term? Yes or no? I mean, if you know that they had just under 1 billion in loans in Q1, that 6 billion is quite a bit. For 2 billion, that's for the first 12 months already. So I mean, that's substantial. There's no time limit on the other one, as far as I know.
Yeah.
Maybe internally there is, but um, so I think there are a few risks, but I think the upside is great as well, and that's why I call it the light buy. I would not go all in with this one. Don't YOLO. But I think that the risk reward, if you're patient, because the stock is very volatile,
Yeah.
and two, it could take a while before Upstart is back to where it was. And but I think if interest rates would be cut, I think this could be. you know,
A potential multi-bagger.
a potential multi-bagger indeed. Indeed, correct. That was the
Kris, thank you so
best
much. I
answer.
think we just hit an hour. That's perfect. Really appreciate your time. Maybe next time I get you on, what I would like, and I don't know if you have done really deep due diligence on SoFi, but I
I
do
have
think it
not.
would.
I have not.
I think it would fit your criteria, uh, I think it's one of those companies. At first glance, it's a bank. When you dive deeper, I think you might like it, especially at these prices.
Great, thanks. I mean, I have looked at it for several times, but
Yeah,
I always dive very, very, very deep, and before I'm convinced. I'm an optimistic, skeptical investor. I think something like that, or skeptical optimist, maybe. Um,
yeah,
yeah, I mean, it's one of the things that I follow up on. It usually takes a long time before I'm fully confident to you know I I I I often have periods in which I research a lot and then I still leave it aside because I want to see how it evolves and etc. So yeah,
yeah,
and of course yeah, there are several investors that I follow, and you're one of them, who are very interested in SoFi and who have investments in SoFi. So yeah,
right.
definitely
No,
interested.
I mean, hey, the things that you're working on, like you don't need to be invested in everything. I can see you posting about Nvidia and everything, and obviously that's paid off for you very well so far, and probably even more to come. So, um, you don't need my help. That's for sure.
Well, and my approach is also I invest for the long term, and
Yeah,
I picked Shopify at split adjusted 7.7
I
or
just read it
something.
today. It was 778.
Oh yeah, yeah, and the trade desk at 19 half.
Guys,
You know,
$7.78.
yep, 2017.
Crazy,
And
crazy.
that's actually when I picked it as a potential multi-bagger. I had actually bought for myself 3 months earlier, and then it was 558.
Well, I'll just say I looked back at my transactions, and I had been a shareholder of Nvidia since December of 2018,
Wow, great.
after the Bitcoin crash. Um, I've trimmed some since then. It doesn't. At one point, it made up 50% of my portfolio during the pandemic. Um, but I should have continued to hold more. But
Well, but I think you did the right thing because if you go to those positions, that could really, make you lie awake at night, and that's not. We still
yeah,
we still make money to live better.
yeah, no, exactly, and good point. Thank you, Kris. I really appreciate your time, my man.
Thank you, Tanner. It was great talking to you again, and see you next time.